The S&P 500, a key indicator of the US stock market, is nearing its all-time high of 6,128. This achievement reflects the market's resilience and investor confidence. It's crucial to understand the factors driving this surge. Is it a result of broad market participation, or are other forces at play? Let's delve deeper into the dynamics of this market movement. The S&P 500 represents a basket of 500 large companies listed on stock exchanges in the United States. When the index rises, it generally means that the value of these companies is increasing. This upward trend can be influenced by a variety of factors, including economic growth, corporate earnings, and investor sentiment. Understanding these factors is essential for investors seeking to make informed decisions. By analyzing the underlying drivers of market movements, investors can gain insights into the potential risks and rewards of participating in the stock market. A common misconception is that a rising tide lifts all boats. However, this is not always the case in the stock market. While the S&P 500's climb suggests overall market strength, it's essential to examine whether this growth is broad-based or concentrated in a few select companies. If a small number of large companies are disproportionately responsible for the index's rise, it raises concerns about the sustainability of the rally. In such a scenario, the market's performance might not accurately reflect the health of the broader economy. To determine whether the current market surge is being driven by a select few or a broader range of companies, we can compare the performance of the S&P 500 to an equal-weighted index. An equal-weighted index gives each company the same weighting, regardless of its size. An equal-weighted stock index treats all its constituents equally, regardless of their market capitalization. This is in contrast to a market cap-weighted index like the S&P 500, where larger companies have a greater influence on the index's performance. For instance, in an equal-weighted version of the S&P 500, a $1 price change in a smaller company would have the same impact as a $1 change in a much larger company. This approach provides a different perspective on market movements. It highlights the performance of a broader range of companies, not just the giants that dominate market cap-weighted indices. Analyzing the performance of equal-weighted indices can offer valuable insights into whether market strength is truly broad-based or concentrated in a select few. By comparing the performance of equal-weighted and market cap-weighted indices, investors can gain a more nuanced understanding of market trends. This analysis can help identify potential investment opportunities and manage risk more effectively. Section 4. The role of equal-weighted stocks in the surge. Comparing the performance of the S&P 500 to an equal-weighted version of the index can provide valuable insights. If the equal-weighted index is lagging significantly behind the S&P 500, it suggests that the market's gains are primarily driven by a smaller group of large-cap stocks. Conversely, if the equal-weighted index is keeping pace with or even outperforming the S&P 500, it indicates broader market participation in the rally. This information is crucial for investors as it helps assess the sustainability and potential risks associated with the market's upward movement. Analyzing historical data and comparing the performance of these two indices during previous market cycles can provide valuable context for interpreting the current market environment. Investors should exercise caution and avoid making investment decisions solely based on the performance of a single index. Section 5. What this means for investors. Understanding the drivers behind market movements is crucial for making informed investment decisions. If the S&P 500's rise is primarily due to a handful of large companies, investors should be wary of complacency. A concentrated rally might not be sustainable in the long run. Diversifying investments across different sectors and company sizes can help mitigate risk. Investors should focus on a company's fundamentals, such as earnings growth and valuation, rather than solely relying on market indices. Remember, investing is a marathon, not a sprint. A long-term perspective, coupled with a thorough understanding of market dynamics, is essential for achieving financial goals.